Hello, my name is Alejandro Martinez, and I am a student from Finance 381 from Southeastern Louisiana University. And today we are going to present a Bloomberg analyst project. This project is going to be focused in the short-term solvency, long-term solvency, and equity investment. The five companies that I choose for this project were Autodesk, Boeing, Johnson& Johnson, Netflix, and Tesla. These five companies are in different industries, and the reason I did this is because I want to have a perspective for numbers for different industries. My first company is Autodesk. It's a company who develops software in 2D and 3D for civil engineer, mechanical engineer, and architecture firms. I am very familiar with the company because I use their software every day at work. So I really want to see where they are and what are they doing and what is the future for this company. The second company I chose was Boeing, and it's a company who is connected with aerospace and defense. The reason I choose this company is because I am a mechanical engineer and I'm always looking for the future and how they're trying to make new technologies and how they are using different resources. So I really want to see how this company is growing because it's going to have a big impact in the future. My third company is Johnson& Johnson's, and they pretty much are in the market of healthcare products, medical equipment, and pharmaceuticals. Every day I have to use a shampoo and soap and different things. So it's really interesting because I know we see all these products like every day, everybody use them. So I want to see how this company is doing. And as you know, they offer too many products. So it will be interesting to see where they are. The next company that I chose was Netflix, and is in the industry of entertainment. Something like always catch my attention was how they were able to put Blockbuster out of the business. And as you can see in this map, they're pretty much in almost every place in the world. And so they have a lot of people translating for different language, different backgrounds. So it's a really interesting company, and it has been growing a lot for the last years. My last company is Tesla, and is a company who is in the field of energy storage and automobiles. I think this is like a really interesting company. They have been growing. Their name is outside. They have like very big goals, and I just want to see where this company is. What is the numbers? Because it's different to see it in this field where you are talking about energy and social responsibility and sustainability. So I'm really interested in this company too. So the first study I'm going to do is for short-term solvency, and in this case, I am going to ask, can I pay my bills without stress? So in this case, I'm going to look for two factors, cash ratio and current ratio, and I'm going to compare them, and I want these numbers as high as possible. Cash ratio is going to tell me how liquidity is the company, and the current ratio, they're going to show me how much current assets they have versus current liability. So the first thing I'm going to do is, in this case, is study the cash ratio. So the cash ratio is telling me first, for instance, if I took this number, it's telling me for every, let's use in dollars, for every dollar like I spend in current liability, I'm going to have 70 cents in cash. So this is a good number. I'm looking for a positive relationship as high as possible. It's going to show me how the money is moving. So if I come to Boeing, this number is low, and thus I can understand that because they are not like selling like 100 airplanes or 2,000 airplanes every single day. So there's not like a cash flow every single day. So it's normal to understand like this is low. However, in Johnson & Johnson, I can see this number is a little higher. We know Johnson & Johnson is selling like products, everybody's buying shampoos, soaps, so they have more assets moving, so the cash flow is higher. So I'm looking for like a good number, so I like this number for cash ratio. I like the number for Autodesk. Netflix it have a good number. It's not as good as Autodesk, but it's still a good number. And Tesla have a 0.3. So they have a better ratio than Boeing, so that's very important. But something like I have to consider in this moment is like cash ratio does not consider accountable receivable, inventories, and others. So it's a good number for me, and it's good to know how liquid is the company, but I also have to consider the current ratio. So current ratio, what is going to help me to explain is how much are my current liability and my current assets. So for instance, if I am, let's take a different company, let's start with Johnson & Johnson. So Johnson & Johnson have 1.58. So it's saying me for every dollar in current liability, I have $1.58 in current assets. So this is very good. It's showing me like the net working is positive. Remember, like the net working capital is equal to the current assets minus current liability. So I'm looking for a positive relationship here. I don't want a negative relationship. So this company is doing very well. They're able to pay the bills they're spending only one for every dollar like they get in liability, in current liability, they have 1.58 in assets. So it's a good number. So when I start to compare these the other companies, I am going to see that, for instance, Tesla have the lowest number, so I really don't want to borrow that money in the long term because they're spending for every dollar in liability, they only have 74 cents in assets. So they have almost like, how much is that? 26%, like it's for my equity, and I don't want this to happen in my company. So remember, we're talking, all of these numbers are in millions of USD, and I'm just saying, making easy the comparison using just $1. So the next company, they have a number, a higher number is going to be Autodesk. They still cannot pay the cash. They cannot pay the bill. They have some stress. It's not as bad as Tesla, but they're struggling with that. So they're still not the best company for me in my case. And then the next company I can see is Boeing. Boeing is have a positive number. The net income is positive. They have 50 cents, like they have extra to play, to do things around. So I like it. I like it. However, Netflix have a bigger number. They have for every dollar in liability 1.3 in current assets. So it's a positive number. In this case, I'm looking for only like two companies. I'm going to choose the best two. So in this case, what I'm going to choose is the two companies who have the higher current ratio, but also I'm going to study the cash ratio as we see. So in this case, I am going to choose company Johnson & Johnson first because they have a positive, sorry for that face, they have a positive current ratio and they have a positive cash ratio. So they're liquid and they're making really good term. They're not going to have any stress to pay me back. And the next company I'm going to choose in this case is going to be Netflix. So I like they are making good numbers and the cash ratio is moving. They have liquidity. So it's two good companies to do a short-term loan. So the second thing we are going to study is the long-term solvency, and I'm going to make them a loan for 5 years. So are they going to be able to pay me this? How much debt they have, and can they afford the debt? So for this reason, we are going to check how much is the debt, total debt versus total equity, and this is the first ratio we are going to study. In this case, we can see they have like a really big number, 2007. And again, if we go just using $1, we're saying like for every dollar in equity, they have $203 in liability. So this is not a good number. Let's remember this is in millions. So for every million like they have in equity, they have a debt, a liability for 203 million. So something is not very good. I don't want to invest in a company just looking this number that have this like big number. So but let's see what else is happening with this company. If we go to the return of common equity, that is my the other factor like I'm going to study, is going to tell me how much return I have for the equity. So if I come to these numbers, it have been in 10, went down, and then it went to negative, and negative very big. This company has having some trouble. But what is driving these numbers? Now the return of common equity, we also study this as the DuPont analysis, and what we say is like the return of equity is equal to the profit margins times the total assets turnover times the financial leverage or the equity multiplier. So what is driving these numbers? What is driving these numbers to keep going down in a way like they're not making any return for the equity? So when I come back here, I'm going to start profit margin, and the profit margin, it was 10, it went down. So they are not making too much profit. Profit margin is net income over sales. So the change in sales and net income is decreasing. That's not good. So for every, let's say for every dollar like I have in sales, I have 3.26 in net income. So this was still a positive, but in this case, for every dollar like I have, I'm losing $28 if we are talking about dollars. So this is driving big. We can see the number for common return of equity. Now this is one. The turn of assets, we can see like it's very stable. Turn of assets is sales over assets. So for every asset they are selling, for every dollar in assets, in this case they're having $2 in sales. We can see it's very stable, this number. So this number, well, they increase here, but it's not like a big increase. Now the last thing, sorry, I was trying to say about this number, the turn of assets is increasing. It's kind of like a stable. Now the financial leverage, it have been like increasing. Well, this increases the double, but still the big number who is making the problems in Autodesk is the profit margin. So actually I did some research about this company, and I found out like in 2006 they have a loss of 330 millions, and in 2007 they have 582 millions, and it's pretty much because they have been trying to restructure the model, and the revenue model is not working as they were expecting. This is the first loss they have in the last past decade. So the company is struggling. They still have a lot of people who use their software. So I personally, I don't like it. I use this software every day, so I want to keep using this software. A lot of people use CAD. Autodesk is like a good software for, we have it in a lot of educations to teach for 2D and 3D. So we will see what's happening with this company. So far they're not doing very well. We don't have any numbers in the earnings before interest and taxes, and in this case depreciation. So we don't have any numbers, so we cannot say anything about the interest expensive. So this is about Autodesk. Let's go and check the last company, and in the end we are going to make a conclusion about all of these companies. So again, I'm going to ask myself how much debt I have. Can I afford this debt? So how much debt they have in Boeing? So we come to the total debt of equity, and we can see this number have been increasing. Oh wow, look at this number, how much? It's almost 10 times bigger. They have been increasing, and it have been increasing. So in the beginning I looked this number and I don't like this, because we were saying, for again, let's go to dollars. For $1 like I have in equity, I have almost 2,700 in debt. So it's a big jump, especially if we're talking about millions. But let's see what else is happening. Let's go to the return of common equity, and the return on common equity, oh wow, look at these numbers. This is good for the equity. There, for every dollar like I have in, remember, like the return of equity, let's start for the basics, is the net income divided by total equity. So for every dollar in equity, I am having, in this case, 100, almost 400 in net income. So wow, this is a good number. So they might have a debt, and they are maybe moving something, they are doing something strategic to generate more revenue. I can see like before they were just giving me 69, almost $70 for every dollar in equity. Remember, this is millions, so for every million is 7 million. So but then they increased this number, and now they just, wow, they went high. This is good. They moved something interesting in this company. And again, when we go to ROE, we have to think about profit margin, we have to think assets turnover and financial leverage. So actually these two numbers, if I take these two numbers together, they gave me a return of assets. So I can look either these two numbers or this number to have an idea what is happening. So let's see, the profit in the company have been, went down, and it's increased a little bit. So they're not having a big difference in the net income versus sales, but it's good. So we can see like this number is not like driving completely the profit margin. Now let's see what is happening with the turnover assets. So the turnover assets, they have been very stable too. So this is not driving at all this return of investment. So the last thing we have here is the financial leverage. So we can see this number have been increasing, and then boom, this number jumped. So equity multiplier, or the financial leverage, we're going to say is equal to assets over total equity. So let's see what is happening here. This company have, for every, let's go for millions. For every million they have in equity, they have 155 assets. Wow, so they have a lot of assets. They have been buying material, they have been getting equipment, getting different things, and what it's doing is like it's increasing the return of equity. So this is good. We can see the profit is not increasing. I mean, it have been increasing from 5 millions to 8 millions, almost 9 million. So the company is growing. I like these numbers. The interest expense, it have been increasing. This is like a good number too, because what this number is telling me is like they can pay me back if I make them a loan, they can pay this back 33% times. So it's a good number. This company actually have like a really good revenues in 2007. It was like almost like 93.400 billions. The operational scale was like 10 billions. The net income was 8 billion. So the company is doing very, very nice. This company, as we know, is like established in many places. They have around like 140 employers. So we know this company is moving. We know there is a lot who have to be like with different things in the industry, new airplanes, more people is flying, more people is investing in defense. So Boeing is doing very well. We are surprised of these numbers. I like them. I'm just cleaning a little bit my presentation, but so far I like this company more than Autodesk. So let's go to the next company and see how they're doing with the return of common equity and others. We're going to try to go a little faster here. We know more about what we're talking about. So the total debt versus equity in this company have been increasing in the last several years. This is very good. I mean, it's not good, sorry. I have, for every million in equity, I have more debt. It's increasing. I don't want to have too much debt from my equity, but let's see what is happening with the return on common equity. It have been increasing. Wow, look at this number. It have been decreasing. Actually, this number have been decreasing, and is very low. Wow. So what is driving this number? Let's see. My profit margin, it have been it's pretty stable here, increase and then went down. Look at this difference of the numbers, 23 versus 1.7. So it's saying me for profit margin, it's saying me from every dollar in sales, I have 1.7 in net income in 2007 in millions again. And in millions, the year before, they have, for every dollar in every million in sales, they have 23% in net income. So of course, this number was dropped. I don't need to look the other numbers. I can see they're a little bit more consistent, and this is what is driving equity multiplier. So this company is better than Autodesk so far, but it's still no better than Boeing. So it's interesting. We can see the EVI in the interest. It have been going down, going down, going down, and it went up a little bit. So they're able to pay the to afford the debt anyway. So it's good. It's a good company in this area. I don't like they are not making too much profit. They went down a lot. It's a big difference. It's interesting because this company have like circles as in almost every place in the world. They have almost like 134,000 employees according to the statistics. They we know they are making pharmaceutics. They're doing different things, but yeah, let's see what's happening with the next company is Netflix. Let's go again. If they can afford the debt, how much debt they have. So this company have significant debt. In this moment, as we can see, they are very close with the other companies. We can see there is not that bad as we can believe in the beginning. So let's see the return of common equity. They have been going down, going up a little bit, going up and going up. So what is driving this difference? I want to see what is happening here, what's happening between 2006 and 2007. Let's use this time the return of assets. So the return of assets, we say was the profit margin and the turnover assets. So these two are equal. So let's study what happened here. So this number I can see in this is increasing. So my assets are returning, is increasing. This is good for me. Is more asset like I am using, and the financial leverage in this case it have been increasing. So I'm not clear what is happening here right now. This return of assets, this increase happened because I have more profit or more turnover. I can go back here. My turnover was very close, but my profit margin increased. Look at this profit margin coming, like it went down for a moment and then they have been increasing in the profit margin. So I like a company who is making more profit. I like this company, and they're making good profit. They can pay my interest expensive. They can pay the bills. I like it. It's still not as good as Boeing, but let's see what's happening with our last company before we make a conclusion to which company I should make a long-term solvency. My last company is Tesla, and again, how much debt they have? Can they afford the debt? So the total debt versus total equity, let's see. It have been decreasing. Interesting. Tesla, look at it. This company have been decreasing. What's happening with the total? Let's go to the return of common equity. The return of common equity have been negative, going down, going up, going down, and it's kind of like going down in this moment. So wow, I don't like something like they have negative return of common equity. And what is driving these numbers? Let's go up again. We can see like the profit margin have been decreasing. The turnover, they have been very stable in the turnover, and the financial leverage have been going down, down, up and up. So we can make sure like here this part is like pretty much what is driving the numbers in this case for the common equity. But wow, they have a lot of negative common equity. I don't like that. I don't like they have negative profit margin. Of course, we know this company is still growing. They are proving what they have. They have some new and very good ideas. They're very ambitious. So I mean, if as a financial, I don't like these numbers, but we have to remember like the return. If we take more, the return have a positive relationship with risk. If I have more risk, I'm going to have more return. So a lot of people spend money in Tesla and they believe this company is growing because You take the risk. You know, green energies are coming. You know, there is a social responsibility. So even though the numbers are not showing something good, we know they're still in business. So it's interesting. So let's compare the 5 companies and see what is our conclusions. So this is slide is just showing the 5 companies, and it was one of the terms we were talking. We talk about this was the first thing we were talking, and then we were talking about the return of equity, return of assets. Then we have profit margin, turnover in the assets, and we have our equity multiplier or financial leverage. So remember, like these two together are ROI and times financial leverage, I have my ROE. So let's see what was happening. So when we study, we didn't go too much to the assets, but we can see those asset number here in the ROE and the turnover pretty much also in the equity multiplier. So let's see what was happening. If we put all the numbers together, Johnson and Johnson have the highest, not the highest, in reality the lowest number in the total equity. Like it's something like I want to see. I want to see less debt for my company. So Johnson and Johnson, it was the lower number. So I like this company. Let's see what's happening with this company. The interest was decreasing, and it was the second from the 5 companies. So this is a good indicator. They can afford the debt. So let's see what's happening. They were decreasing in the ROE, and they were decreasing. Well, this is kind of like number 3 in the company. I just make like a number. The total assets, it was even. So this company is kind of like number 3. Interesting. So let's see the other companies. Autodesk was increasing in the total liability versus total assets. So I want this number low as possible. I want less. I want as many assets I can that they're already paid. So they have been increasing that number. I don't like that number. I am missing the information from the interest. So I really don't know if they can afford a long term. And then they have like a negative numbers in my ROE. So I don't like this company. This is not like a company I want to make like a short-term solvency. This is not good for me because I use their software every day, and I need to keep working in my cuts to pay my bills too. So this is interesting. Let's see what is happening with Boeing. Boeing is look, the total debt versus equity it was the highest number in this case, because we were looking for a lowest as possible, and this one was the highest in my case. So I don't like that number, but they have been decreasing other things. It have been the number 1 in other parts. It have been increasing the ROE, have been increasing the return of assets. Man, I like this. And the profit margin is increasing. The total assets have been like equal, and they have been increasing in the equal multiplier. So it's a good company. I like this company other than Autodesk or Johnson and Johnson. So far I'm going to say like this is my company number 1. This is my company number 2, and this is my company number 3. So what's happening with Netflix? Let's see. Netflix have been going up and down with their assets. The equity it was the number 2 in my list. So if I have to come just looking these these numbers here, I like this company more than my second company. Like it was actually, well, never mind. This company was higher than this one. So I still like Johnson and Johnson more like Netflix. Just looking this number. Sorry about the confusion. They have increasing in the EBIT. So I like when they increase this number. More than decrease, even though they maybe were like little different, it have been increasing. Then it have been increasing in the ROE, ROI have been increasing, project margin have been increasing. I like it. It's very stable when they turn off the assets. So I'm going to say, just looking this like this company, I like it more like Johnson and Johnson. Autodesk, we're going to put this in the number 4 so far. Text like next is going to be my company number 2, and this is going to be my number 3. And let's see what's happening with Tesla. Tesla is going down, increasing the debt. Have a decrease, interesting decrease here in the interest. They have negative numbers. So this company is not looking just the financial statements, they're not doing very well. So with these conclusions, I'm going to say I'm going to make a long in the long term to Boeing and Netflix. Pretty much, I'm taking my decision again based in my total liability and my return of equity based in the other factors. So it's interesting. I don't like what is happening with Autodesk. I don't like what is happening with Tesla because they're a company like they promise a lot, and but unfortunately they cannot cover the bills and they have negative numbers. Johnson and Johnson can cover the bills, but it's still not as good as Netflix or Boeing. So I'm going to make long term to Boeing and Tex and Netflix. The last thing we're going to start today is if I have to invest in two companies, which are these two companies? And pretty much I'm going to look the ROE, I'm going to look the current ratio, I'm going to look just some numbers like we already speak, and also the price earning per ratio. So I'm going to start just thinking in these two companies like I decide to invest, that I decide to do a long-term loan using the long-term analysis. And so as we can see, we decide that we're going to do it in Boeing because they have a really good return of common equity. We say this number was increasing um, because the profit margin was driving this number that I really like. We see they're like investing money, they're like looking for something, they're making good project profit margin. So I like this company. We say they're able to pay the debt in the short term. So the current liability is lower than the current assets. I have like positive net worth, and the price of book, it have been, look at this, it went increase, jump, and in the last 12 months it have been decreasing. But if we remember, I think was the close day was here 1231, and here we are only going in 431, so it's still increasing. So I like this. The price earning per ratio is a positive number. I like this number. um, I'm going to receive some money when I invest in the equity. And so I like this company. I'm going to invest in Boeing based in, as I said, in my short-term solvency and long-term. And the other company I decided to invest, it was in Netflix. We decide, well, looks like I'm missing some of the numbers here, but we decided like the current ratio was like, also it was like positive. The return of equity, it was very good. I think we say it was the turnover and the profit margin was like increasing. We know like Netflix is increasing in all the countries. So I wanna have like investment in a company like it's not only based in one economy. So I like this, and the price for earning, look at this number, is good, man. It's going to give me some good money. So I like this company. So in conclusion, we're going to make an investment in these two companies. This is my study for my boomerang analysis for finance. And thank you for listening, and we'll see you soon. Bye bye.